The older I get, the less impressed I become by complicated explanations for simple economic truths. People like complexity because complexity allows them to hide from arithmetic. They can say the world changed. They can say the system is unfair. They can say wealth is mysterious. They can say the rich know something ordinary people never get to hear. I do not believe that. When you boil wealth all the way down, most of the noise disappears. A great deal of financial language falls away. Prestige falls away. Online performance falls away. And what remains is something much simpler than people want it to be. There are only a few real ways to become rich. Not comfortable, not respectable. Rich. By rich, I do not mean a person with a nice salary and a fragile life. I do not mean a household with polished furniture, 2 financed cars, and permanent low-grade financial pressure hidden behind good lighting. I mean a person whose capital has detached itself from his labor enough that his life begins moving under a different set of rules. That sort of wealth does not come from 10,000 little hacks. It does not come from clipping coupons while financing a lifestyle too large for your real structure. It does not come from sounding informed at dinner. It does not come from memorizing financial phrases. It comes from ownership. And ownership enters a life in only a few durable ways. You build the machine. You buy the machine. Or you enter an existing machine. Position yourself close enough to the control room that you can convert your income into ownership. And then you let the ownership do what labor by itself never can. Everything else is commentary. That is the great economic truth. Most people spend half a lifetime circling without saying plainly. They say work hard. They say get a better job. They say invest. They say start a business. They say climb the ladder. Fine, those are fragments. The real question sits beneath all of them. At what point does your effort stop being sold 1 hour at a time and start owning something that can scale beyond your body? That is the dividing line. The reason most people never cross it is not that the truth is hidden. It is that the execution is emotionally brutal. The roads are simple to describe, they are hard to live. That is what I want to explain. Because the modern world has become very good at creating the appearance of wealth without the underlying structure of wealth. A person can earn $300,000 a year and still be standing on a trap door. Another person can earn less, own more, and be moving steadily toward freedom without looking especially dramatic from the outside. The outside fools people. The inside is what matters. A salary has a ceiling. Ownership does not. That sentence alone can separate a lifetime of confusion from a lifetime of progress, if a person really absorbs it. Salary grows linearly. Perhaps your income rises 10%. Perhaps you negotiate well. Perhaps you switch firms. Perhaps you become more skilled. Good. I am not insulting salary. Income matters. But income tied directly to your time, your attention, your negotiation, and your willingness to remain in the arena is still fundamentally labor. Even highly paid labor remains labor. Ownership behaves differently. If you own 60% of a company and that company's revenue goes from 1 million to 100 million, your life changes on terms no salary path can easily imitate. If you own rental properties that throw off cash while appreciating over long stretches, your life changes differently from the person whose monthly survival depends entirely on payroll continuing smoothly. If you own index funds for decades and keep feeding them while the machine of enterprise grows, your capital slowly becomes another worker in the room. That is the heart of it. The public often confuses compensation with wealth, because compensation is the visible stage of the process. Ownership is quieter at first, then it becomes everything. Let me start with the first road. You build the machine. This is the most romantic road and the most misunderstood. People speak about entrepreneurship as though it were mostly passion. I do not believe that. Passion is fine. Passion can help a tired person keep moving. But passion by itself does not create wealth. A great many people are passionate about things that have no scalable economics. Building a machine means more than creating something. It means creating a value-producing system that can keep creating value with less and less dependence on your personal hands as it grows. That distinction is, a person can open a cafe because he loves coffee and still build himself a prison with nice branding. He can work long hours, manage difficult staff, worry about margins, depend on local foot traffic, and call it ownership, while in truth, he simply purchased a more stressful job. That is not the machine I am talking about. The machine that creates wealth has to detach from the founder's labor. It needs repeatability, it needs distribution, it needs margin enough to reinvest, It needs a market large enough that scale changes the economics. It needs enough retained ownership that when the value expands, the founder actually gets paid for controlling the thing rather than merely operating inside it. This is one reason I have always disliked the way entrepreneurship is sold to the public. It is sold as courage, as creativity, as independence. All of those may matter. The deeper issue is structural leverage. Can this thing scale? Can it move from one customer to 1,000 to 100,000 without cost rising in direct lockstep? Can you standardize delivery? Can you own enough of it when it succeeds? Can you defend the economics with distribution, brand switching costs, or some other moat? Once the market notices the opportunity, that is what creates wealth. Not effort by itself. Most people fail at the wrong point and do not even know it. They think the problem is that the product was not great enough. Sometimes that is true. Very often the problem is simpler. They built a job instead of a company. They never formalized the thing well enough for scale. They never gained distribution. They never controlled margin. They gave away too much equity too early. Or they were building in a shrinking market and asking talent to outrun gravity. I have watched many fortunes be born because the founder entered an expanding system at the right time and retained enough ownership for the expansion to matter. The internet did this for one generation. Mobile ecosystems did it for another. Cloud infrastructure did it for another. Artificial intelligence and semiconductor demand may be doing it now for some. People love to tell stories in which founders are geniuses beyond measure. Some are. Many were simply operating in an expanding environment that multiplied all competent effort. Timing is not everything, but it is a great deal. A decent business in an exploding market can travel much farther than an excellent business in a stagnant one. That is another truth people dislike because it introduces luck into a subject they want to interpret as pure merit. The first road is therefore simple to state and brutal to execute. Find an inefficiency or a need, create a repeatable solution, make delivery reliable, build distribution, protect margin, retain ownership. That is the formula. The pain comes from the nature of the road. The income is unstable. The identity is unstable. The feedback is often brutal. The market votes every day, and most days the vote is not flattering. There is no salary cushion unless you create one yourself. This is why the building road attracts extreme personalities. The payoff distribution is not normal. You may lose years, you may lose capital, you may lose face. But if the thing works and you own enough of it, the upside can be generational. That is because equity does not reprice linearly. If revenue rises 10 times and the multiple the market is willing to pay also rises, the owner is no longer living in a world of linear reward. This is where people looking from the outside say founders are overpaid. No, they are not being paid for labor. They are being paid for control over a scalable asset. That is one road. Not the only road and not the right road for everyone. Not everyone is built to live inside that sort of uncertainty. That does not mean they are excluded from wealth. It means they may need the second road. Buy the machine. This is the road I suspect ordinary people underestimate and underuse because it does not flatter the ego in the same way. When you buy the machine rather than building it, you are admitting something psychologically difficult but economically wise. You do not need to invent the engine if you can own part of engines that already run. A lot of people resist this because they still want the story of exceptionalism. They want to feel. They found the one perfect stock, the one underappreciated property, the one private business opportunity nobody else noticed. Maybe they do. The public story of wealth loves those examples because they are exciting. The underlying reality is usually duller and more generous. Most long-term wealth compounds through ownership of productive assets. That is the whole mechanism. You allocate capital into systems that already create value and then let time, reinvestment, and disciplined behavior do the scaling. A profitable company keeps operating whether you show up or not. A rental property, well chosen and sensibly financed, keeps collecting rent whether you are at lunch or asleep. A broad low-cost index fund keeps owning productive enterprise while weak companies leave and strong companies rise. This is what makes the ownership path so attractive. It decouples wealth from direct labor. Not fully at first, not magically, but structurally. That difference changes everything. Most people think investing is about brilliance. They are wrong. For the ordinary person, investing is mostly about disciplined capital allocation over long stretches. That is not as glamorous. It is much more useful. The mathematics are not mysterious. If you invest $100,000 at 8%, the first year's gain is not enormous. It looks almost disappointingly ordinary to a person trained by social media to expect fireworks. Then the base grows. Then the return grows with it. Over time the shape changes. This is why I say time is the hidden multiplier. Not because time is a decorative factor. Because duration is what bends the line upward. A person who keeps contributing and reinvesting is not merely piling up dollars. He is building a mass large enough that the return itself starts becoming a meaningful source of growth. That is a different experience from labor. That is one reason I care so much about avoiding catastrophic loss. Once you understand the ownership road, the next question becomes obvious. What counts as a productive asset? A productive asset is an engine. It either throws off cash, appreciates because it sits on real earnings power, or does both. A business qualifies, broad public equities qualify. Real estate can qualify if it produces sensible cash flow and rests on reasonable economics. Private businesses qualify. Private equity can qualify if the underwriting is rational and the owner understands what he is doing. A broad low-cost index fund qualifies because you are buying a slice of aggregate corporate earnings and letting the machine of capitalism work over time. What does not qualify? Pure consumption, objects that only lose value while flattering your identity. Speculation without cash flow. Things you are buying only because you hope someone more emotional than you will pay more later. I have seen eras where that sort of speculation seems to work for a while. That does not transform it into wealth building. Spikes build stories. Durable productive assets build wealth. That is why the buying road is slower in the early years than the building road, but often more stable. It does not require the same operational chaos. It does not require the same emotional tolerance for founder life. It does require patience, surplus, capital, and discipline, which is why many people still fail at it. They interrupt the process. They buy during optimism. They sell during fear. They chase whatever recently performed. They mistake motion for judgment. They confuse market commentary with a strategy. Then later they conclude investing did not work. No, their behavior did not work. Consistency beats brilliance far more often than people want to admit. The person who keeps buying productive assets across long stretches and reinvests cash flow is doing something very powerful, even if he looks boring to the crowd. He is slowly transferring the burden of his future off his own back and onto the back of the machine. That is what ownership does. But there is still a practical problem. Not everyone starts with capital. Not everyone wants founder risk. Not everyone has enough surplus early in life to simply buy large enough machines for ownership to change the game quickly. That leads to the third road. Join the machine, then convert income into ownership. This is the bridge path, and in many ways it is the most common path for modern upper middle class wealth. You enter an existing high-value system, you acquire a scarce skill, you move close to leverage, you put yourself near revenue, near large deal flow, near software platforms, near global enterprises, near decision makers, near stock compensation, near carried interest, near bonus pools tied to enterprise value. Then you do something most high earners fail to do. You convert the elevated income into productive assets before lifestyle inflation eats it. That is the whole game. Most high-income people do not become wealthy because they misunderstand the final step. They know how to enter a strong system, they know how to become useful, they know how to collect a large salary. Then they break the machine by treating the salary as proof of permanent permission to become more expensive. That is one of the saddest patterns in modern finance. A person gets into software, into finance, into enterprise sales, into law, into corporate leadership. He starts earning at a level the median household can barely picture. And yet when you inspect his actual balance sheet years later, he is not structurally rich. He is merely highly compensated. Those are different conditions. A highly compensated person can still be fragile. A wealthy person has detached at least part of his life from the continued need to perform labor at that level forever. That difference matters more than income. The bridge path, therefore, has 5 real phases. First, you develop a scarce and economically valuable skill, not a hobby, not a fashionable identity. Something that actually drives revenue, reduces cost materially, manages risk at scale, allocates capital, sells complex systems, builds tools for millions of users, or otherwise positions you where value concentrates. This is the first misunderstanding people have about careers. They think passion should lead. I think the safer question is often simpler. What can I become very good at that the world reliably values? Skill scarcity creates pricing power. That is what you want. Second, you choose the right system. A strong skill inside a weak system still caps your upside. A strong skill inside a scaling system expands it. This is why industry selection matters so much. A mediocre operator inside an expanding technology platform may make far more money than a highly diligent professional inside a stagnant and structurally weak field. The world is unfair that way. A person should understand that early. Do not only ask what role you want, ask what machine the role sits inside. Third, you move close to capital. This is where many people stall. They become very good operators but remain far from the profit pool. They make the machine better. They do not negotiate enough participation in the machine's value. The bridge path becomes powerful when stock compensation, profit share, bonus structures tied to enterprise value, or some other form of upside begins entering the picture. That is the inflection. It is not enough to be useful. You must become useful, close enough to ownership that your usefulness can be converted into claims on the asset base rather than only into a slightly larger salary. Fourth, you convert aggressively. This is the stage most people miss. A person earning $400,000 who lives on $120,000 can deploy $280,000 a year into productive assets. That is an astonishing compounding machine. A person earning the same amount and spending $380,000 has created a very polished trap. The difference is not intelligence. The difference is conversion. Every bonus, every vest, every windfall, every promotion, they must become ownership, not only upgraded consumption. If they become ownership, the bridge path works beautifully. If they become lifestyle, the bridge collapses. Fifth, eventually, labor becomes optional. That is the exit from the bridge and the entry into the second road. The income created by assets and ownership becomes large enough that the person is no longer negotiating with life from the same place. He may still work, he may still be ambitious, but the tone has changed. Now labor is a choice in a way it never was before. That is what wealth means to me. Not yachts, not applause, not being seen, choice. Now, these three roads sound simple because they are structurally simple. Build the machine, buy the machine, join the machine, and convert labor into ownership until labor stops being the sole pillar holding up your life. The reason people fail is not that the roads are hidden. It is that each road has a different emotional tax, and most people never learn to pay the right tax willingly. The builder pays with uncertainty. No stable salary, no predictable emotional climate, constant feedback from the market. The owner pays with patience, slow visible progress, the requirement to stay invested, the discipline to ignore fashion. The bridge walker pays with restraint. He can earn far more than his peers and still ruin the whole thing if he cannot convert income into assets fast enough to outrun his own appetite. That is why execution matters more than understanding. The world is full of people who understand just enough about wealth to sound informed and then live in total contradiction to the things they say. They praise compounding and spend every raise. They admire founders and then build jobs instead of systems. They enter high-leverage careers and then buy liabilities to display success instead of accumulating ownership. They know the rules. They do not live the rules. That is why I have always cared more about operating systems than slogans. A bad operating system can make a smart person look foolish for decades. A strong operating system can make a merely decent intellect produce a remarkably strong life. What then is the common law across all three paths? Ownership. That is the answer hiding in plain sight. The first road says build something and keep enough of it. The second says acquire pieces of systems that already produce. The third says use income to buy your way into the second road as quickly and consistently as possible. All three roads point to the same final truth. Wealth flows toward ownership of scalable productive assets. If you do not own productive assets, your effort is enriching the people who do. That sentence is severe. It is still true. People sometimes become angry when they hear it because it sounds like an accusation. It is not an accusation. It is a map. If a person is working hard and still not moving, the question is not always whether he needs to work harder. Sometimes he needs to change where the surplus is going. Sometimes he needs to stop calling a salary strategy a wealth strategy. Sometimes he needs to stop using debt to consume and start thinking about capital allocation. Sometimes he needs to stop performing success and start building it. That is the emotional part nobody likes. The public thinks wealth is mostly about intelligence or effort. I think wealth is more often about identity and behavior than people want to admit. Can you endure uncertainty if building is your path? Can you endure boredom if buying is your path? Can you endure prosperity without becoming more expensive if the bridge path is your path? Those are character questions. Character compounds too. This is one reason I distrust modern financial advice that focuses almost entirely on tactics. Open this account. Use this tax rule. Buy this fund. Negotiate that salary. Fine, tactics matter. But tactics in the hands of a weak operating system do not save a life. A weak operating system turns every tactic into another toy. A good operating system turns plain tactics into momentum. That is the difference. Now, I should say something about luck because people get sentimental and political around this subject very quickly. Luck matters enormously. Where you are born, what era you are born into, what temperament you have, whether your skills match the age, whether you encounter mentors, whether your health holds, whether your market expands or contracts during your building years. I have never had trouble admitting that luck plays a large role, but luck does not eliminate structure. Luck can place two men in roughly the same environment and still watch them produce wildly different futures because one understood ownership and the other never escaped consumption. One entered the machine and converted. The other entered the machine and displayed. One built systems. The other built overhead. That is not fate. That is architecture. Wealth is architecture long before it is appearance. I have met people who looked rich and were not. I have met people who looked modest and were structurally very powerful. You can usually tell the difference by asking one question. If labor stopped tomorrow, what remains? That question cuts through a lot of theater. The first man says, I have a large income. Good. If labor stopped tomorrow, what remains? The second says, I own broad equities, a piece of a business, a paid-down property, some private holdings, cash flow, and options. Now we are in a different conversation. That is why I define wealth differently from the culture. The culture sees consumption. I look for detached capacity. The culture sees compensation. I ask about retained ownership. The culture is always talking about how much someone makes. I am usually more interested in what someone owns and what he keeps. That is the whole game. If I were speaking to a younger person trying to choose among the three roads, I would say this. Be honest about your temperament. Do not choose the founder road because it sounds heroic. If your real gift is patience and disciplined capital allocation, do not choose the ownership road and then sabotage it by demanding constant excitement. Do not choose the bridge road and then let your lifestyle eat all the equity before it ever reaches your balance sheet. Pick a road that fits your real nature. Then align your behavior with the economics of that road. The founder must build for scale, distribution, margin, and retained equity. The owner must accumulate, allocate, reinvest, avoid catastrophic loss, and stay in the game long enough. The bridge walker must acquire scarce skill, enter a leverage, rich system, negotiate proximity to profit pools, and convert income before the world teaches him to become expensive. Each road is clear. Each road is hard, and all three roads lead through the same door eventually. Ownership. That is why I say the truth is simple. People are not confused because the answer is complex. They are confused because the answer is emotionally inconvenient. It asks them to trade certainty, boredom, or pleasure for a different future. That is never a popular trade in the present. The present is very persuasive. It always wants the money. The future is quieter. It has to be defended by principle. That is what makes wealth so rare, even though the structure of it is not secret. Secret knowledge is overrated. Secret discipline is much rarer. Most people can understand these three paths after one serious conversation. Much fewer can live one of them long enough to cross the invisible line, where the machine finally begins helping enough to change their life. That is the line that matters, not understanding execution. The world wealth keeps giving prizes for aligned behavior. That is the standard I trust. Not whether the story sounds good, whether the structure detaches life from labor. That is the only true test I know. And when I boil it all the way down, I still end up in the same place. Build the machine, buy the machine, or join the machine and convert income into ownership until your life begins obeying a different set of laws. There are not many roads. There are only a few. The difficulty is not finding them. The difficulty is having the temperament to stay on one long enough for it to matter.